Futures and options on futures may involve substantial risk and may not be suitable for all investors.
All right, welcome back, everybody. John Caruso here, Monday morning, May 16th. Quick look at the market this morning. We do have stock prices coming in modestly here. We did see a very aggressive rally at the end of last week where we did see the S&P finish 4% off of the weekly lows. We still finished down approximately 1.5% for the week. We got gold prices flat to lower right now. Oil prices flat to lower. Big story going on right now in wheat. It looks like India is banning their exports of wheat, which has the wheat market up roughly about 5%. So we've seen 17 consecutive months of food price inflation, and that doesn't look to be abating anytime here over the near term. So last night we also did hear from the Chinese economic data. We saw an 11.1% drop in Chinese retail sales. Gotta say, I've seen that one coming here with the zero COVID policy lockdowns over there. We also did see their unemployment rate surge to approximately up 6.5%, which is very close to the highs that we saw going into the pandemic of March of 2020. So as we look at the markets right now, we still think gold at present levels, an allocation still makes sense. We're seeing a big squeeze back to the downside, and we really are testing a trend breakdown in the price of gold at the present moment here. So need a little more time and space to determine what the next big move in gold prices is. We still think it's back on the upside. I think gold right now is in the throwaway phase where investors are basically selling anything that isn't nailed down, trying to cash up, wanting their money back, and out of this market from any exposure. And I think that's going to end up being a net positive for gold prices over the long haul. We'll see how that plays out. So it's the bond market right now is also, we are seeing yields come in a little bit this morning. We also think the 2-year yield actually makes, or the 2-year note makes a lot of sense at present levels. You're sitting at 2-year notes yielding about 260, whereas the 10 years are looking at about 280, and you go a little bit further, you're a little bit above 3% on the 30-year. I think 2-year notes makes a lot of sense right now. I do think at some point you're going to start to see some capital flow into the short end of the curve, looking for a place to kind of camp out and hide out, as opposed to standing in front of a lot of this equity volatility that we're seeing. And I still don't think it's over. Sure, we could see some intermediate term rallies in stocks, but I think there's a ton of risk coming out into the fall of this year as well. So that's all I have for you here at the moment. If you have any questions, feel free to reach out. I'd be more than happy to discuss some of these macro developments with you. Once again, we think an allocation to gold makes sense here, and also an allocation to the 2-year notes. So any questions? Once again, I'm John Caruso. We'll catch you back here next time.